Welcome everyone to another episode of The Analyst. Today we'll look at a real-life example of a company that we actually valued in our one of our articles. It's Dar Takaful. It's an Islamic Takaful insurance company. If you look up the article here, there was a rights issue by the company. So the question here, as an investor, should I actually subscribe or not subscribe to the rights issue? Let's say that what should we do as an analyst? First of all, there's a company. It's a company, let's say, you don't know much about, so you go to a website like Mubashir and look up the Dar Takaful. This is the ticker, and you try to find the basic information about the stock. First thing, let's look at the book value, or actually the par value of the stock. It's 1 dirham. The market value, which is 141 million dirham. You can also look at the price of the stock, which is 1.41. Then if you multiply it by 100 million shares, the outstanding shares, so you come up with a market cap of 141 million dirham. What is the bidding capital? It's 100 million. It's basically 1 dirham of par value times 100 million of number of shares. You come up with 100 million dirham for the bidding capital. What is the book value? Book value should actually include retained earnings, but actually the book value per share here is less than the par value. It's at 56 fils, or 0.56 dirham. It's less than the par value. It's almost half a dirham. So it's less than the par value. This includes, or this implies, that the company has negative retained earnings. Today there was some news about the company, that the company is actually going through private equity, through a rights issue being offered to existing shareholders. And the question here, should we buy this stock as part of the rights issue or not? And the rights issue usually is done at the price of the par value, which is 1 dirham. And as we mentioned, the price of the stock now is trading at less than the par value. What do they want to increase their capital? To try to support the company, because actually the book value per share is less than 1 dirham. So actually it is very for the company to continue operations, they need to shore up some capital to continue as a going concern. We've seen some issues taking place also in other companies in the market, in Dubai market to be specific, like Arab Tech and DSI. And this company here, Dar Takaful, they want to increase capital. Okay, so look at the stock. We looked at the stock details. Look at the company itself, when it was established, who are the board of directors. Okay, you look at all these details to make sure to basically try to understand the business, try to understand what the company is all about. They have a company here, for example, an investment company called it's for fixing cars. Given that they're an insurance company, they want to make sure that the companies they actually make money also of fixing company clients' cars. This is the website for the company. You can look at read more about the company itself through its website. Here are some news that you can actually look at you can go through the news as well to make sure that you understand what's going on in the company's history. Okay. You can look also at the fair value of analysts in the market. Fair values. Actually, it seems no fair value. No one's covering the stock, but we are gonna cover it now. I'm actually gonna value it. You can look at the recent corporate actions. The capital increase here actually story, the rights issue has been there since June 2016, so it's over almost a year since they made the decision, but they just took the steps only recently. You can also look at the recent profits. Look at the company's profits. Actually, they've been making money in the past, but more recently, been losing money. Here in the last year, they lost some money. Actually, they made a small of a profit compared to a huge loss of 90 million the year before. You can also look at the detailed financial statements to make sure that you read the footnotes, to make sure that you understand what's going on at the company. As I mentioned, the annual financials, they show that they made a loss in 2015. Only in 2016 they came back to make a profit. You can look at other financial indicators. This is a financial services company. It's an insurance company. So one of the important KPIs that you should look at is, of course, ROE, return on equity, 26.06. 26.09%. This is based on the latest quarter results, which is the fourth quarter of 2016. You have also return on assets, 3.35%. You have the EPS and so forth. First of all, let's value this company. First of all, we have to spread some numbers into Excel, and here we spread some numbers from the balance sheet, just high-level numbers. We put in the assets, the liabilities, and the equity as well, and you have shareholders' assets and liabilities. Before looking at this, we have to understand what the Takaful business is about, because it's a bit different from insurance, but it's the same concept but different structure. Here we have a participant. Who actually pays a contribution that we call premium, and they make a wakala. This is the wakala fee. It's a percentage of their contribution, of their premium, and this goes to the shareholders fund. So the excess available to the fund after paying all the fees or the benefits that they, or the claims that they have to pay to the participants, whatever is left over is actually part of or owned by the shareholders fund. So basically, you have the participants, they make a fee, and they get benefit as well from any claim that they file. So the problem here is whether the fund has a surplus or a deficit. If it has a surplus, that's all good. If it has a deficit, that's not a good situation, and the company would have to look for capital, and that's why the company now is actually raising capital to finance this deficit, because they have a deficit now. They're running a deficit in their financials, and that's why they're raising capital. They spend more than they have actually made money in the past. So you see the deficit here is 82 million dirham. The fund itself, the Takaful fund, has assets 288. Total liabilities is higher than the assets, and that's why you have the net assets as a negative number. And the deficit here is being provided by the company itself that runs the business. So that's why the company's been using up its capital. Okay, let's look at the ROE. The ROE here is 10.11. It's basically looking at net income of last year divided by the average of book value of the previous 2 years, between 50 and 56. This is the 10%. This is the 10%. So you have the ROE, you have the cost of equity. You can calculate cost of equity. Let's assume it's 8%. For the growth rate, let's say it's 5%. So your justified price to book is ROE minus G divided by cost of equity minus G. So you're growing at 5%, and the company's ROE is higher than the cost of equity, and that's why you would pay more than the book value. Let's say the cost of equity is the same as the ROE, you would only pay the same amount as the book value. But since the company is actually making a return on equity higher than the cost of equity, you can actually you could be willing to pay more than the book value. It's 1.73 times the book value per share. What's the book value per share? It's 0.56 times the 1.73. You come up with a fair value of 0.96. Based on the market price of 1.141, this implies that the stock is being traded at 2.53 times its book value. It's a bit overvalued. It's overvalued than our fair value based on the ROE, cost of equity, and growth rate assumptions that we've laid down here. Actually, we see a 32% downside to the stock price. We're not sure exactly. 10% could be a bit higher in the future, but what we can see now for the time being, that this company or the company's management, they're able to generate only 10% of ROE. So we're not going to be making any outstanding assumption. We actually think at the end of the day that the stock is a bit overvalued, so the recommendation would be that you should not actually subscribe to the rights issue because it is overvalued. If you pay that amount, it's a bit overvalued. The fair value is a bit out of whack from the market. Thank you.